Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode number 185 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. But this week, due to Matt's travel schedule for work, I have Nick Whitaker joining me on the podcast once again. It's been a while, Nick. We were on a pretty good clip there together when Matt was traveling earlier in 2022, but it's been a while since you've been on here with me, buddy.
Yeah, I know. It's I've taken a bit of a hiatus for everyone, so it's good to be back. Nice to do this again.
If everyone remembers what Nick's face looked like, it looks like it's right on the screen for you. So
not much has changed.
Not much has changed. No, even though it's a new year, we're both a little older, but not much has changed. The markets have changed though, a little bit to start the new year, which is good though, right?
Oh, they certainly have.
Before we begin, as always, just take the first few minutes to recap the performance for the month and the year, which is obviously the same since we are recording this on January 19th of the major indexes that we track. And these numbers are as of the market close on January 18th. And the data is from Y-Charts. S&P 500 index up 2.33% to start the year. The Dow Jones Industrial Average up 0.45%. NASDAQ Composite Index up 4.69%. The Russell 2000 Small Cap Index is up 5.29%. And the Vanguard International X United States ETF is up 6.88% to start the year. So a little bit of outperformance from technology, small caps, and international, which is interesting. And then the 3-month Treasury yield sitting at 4.69%, the 2-year Treasury yield at 4.06%, and the 10-year Treasury yield at 3.37%. Moving on to big headlines and current events, producer price index for final demand decreased 0.5% month over month in December. Consensus was a decrease of 0.1%. And on a year-over-year basis, the index for final demand was up 6.2% versus a revised 7.3% in November. I think the big takeaway here, Nick, again, for those that might not be as familiar with the podcast or the producer price index, it's what producers are paying for prices, right? For input costs. So it's kind of the opposite from the consumer price index, what we're all paying for goods and services, right? It's just for the producers who are making the goods or services, their pricing as well. So I think the key takeaway is that while it showed, the desired slowdown in year-over-year headline and core PPI, the absolute levels remain pretty high. So, obviously we're going to want to see, and the market's going to want to see a continuation of this trend coming in the next couple of months. And in addition to that, total retail sales fell 1.1% month over month in December. Consensus was a decline of 0.8%. And again, key takeaway from this report is that, the sales in the most discretionary categories fell for the second month in a row, with department store sales, going down pretty significantly to 6.6% after falling just 3.2% in November. So, we're in this process of prices are starting to come down for consumers and producers. But now retail sales are starting to come in, right? And we talked about that this was probably going to be an unfortunate byproduct of this whole inflation getting it under control, that, people eventually are going to start pulling back. And that's typically behavior that you see during a recessionary environment. Now, it's not a foregone conclusion that we're going to get a recession this year, but I think the consensus is that at some time in 2023 there will be a recession, and this is one of the things. Retail sales coming in is something that they look for to highlight that we are in a recessionary environment.
Yep. Yeah. The only thing I'll add is this is pretty normal from an economic cycle perspective. This would be to be expected.
Right. It's like a stock price, right? It can't keep going up and up and up every single quarter, every single month, every single year, because that would be unhealthy. And the same thing for these economic indicators like retail sales. It's just not something that's going to continually go up all the time. Now, we're in good environments more than we are bad environments. So over time, retail sales are increasing, but obviously during slowdowns, we're going to get pullback in consumer spending as we start to see more layoffs and the unemployment rate increase. This is all expected and shouldn't come as a surprise to anybody, I don't think.
Yep. Indeed.
So moving on to tweets, articles, and research from the week. First thing I had was a blog post from JC Peretz on January 5th. And it's titled "Santa Showed Up, So Now What?" So at the end of last year, Nick, we talked a lot on the podcast about the Santa Claus indicator, right? So again, just to reiterate, the Santa Claus indicator is the performance of the S&P 500 the last 5 trading days of December, plus the first 2 trading days of the new year in January. So when that 7-day trading span is positive, the likelihood of the next year being pretty good is high. Well, there's 2 other indicators that go along with the Santa Claus rally, and these were developed by Yale and Jeff Hirsch from the Stock Traders Almanac. So another indicator that they look at is the first 5 days of January. So again, first 5 trading days of January, when you have that 5-day span positive, the likelihood of this year being positive and well into the green is pretty high. And typically when you get a combination of a positive Santa Claus rally, a positive first 5 days of January, it increases the likelihood of the next year being pretty good. And in addition to that, there's one more, well, actually kind of 2 more. One more is the January barometer, when the whole month of January of the new year is positive. It's another feather in the cap of the bulls that the likelihood increases that the year is going to be positive. And then if we wait until the end of the first quarter and the markets haven't undercut the December low that was made, that's like, explosion to the upside, super bullish, hit rate is huge. And we'll talk about that more as we get into the end of January, obviously, and at the end of the quarter to see if we've undercut the lows that were made in December. But JC says, just pertaining to the first 5 days of January, that the last 47 up first 5 days were followed by full year gains on 39 of those occasions. So that's a hit rate of 83%. And the average return is up nearly 14% for those years as well. So on the contra side, the numbers fall off dramatically when the first 5 days of January are down, coming in negative about half of the time and an average return of less than 1% returns for the year. So just solely that the first 5 days of January this year were positive is a tailwind, I think, going into this year. And I know some people might, think we're crazy for talking about this stuff, and does this stuff have even, any real meaning? But if you look back at the data, which we have data going back to the 1950s, it's pretty interesting seeing how these indicators can forecast at least how the market is going to do to a certain extent. So again, Santa Claus rally was positive. First 5 days of January were positive. We'll see if the January barometer, the full month of January, is positive for the S&P. And then the fourth key, we have to wait until the end of the quarter to see if we've undercut the December lows. So as of right now, the train is on the tracks, Nick, and we're looking good so far.
Yeah, absolutely. It makes sense too. I believe, correct me if I'm wrong, but January, generally speaking, is from a seasonality perspective on just kind of a month-over-month view. January is typically weaker relative to other months of the year.
It is. It is.
So a lot of that makes sense to me. You have a strong January out of the gate. And if you're, in a seasonality of a month that is typically weaker if you're not going to retest that December low. That is very positive from a technical perspective. So
Yeah, absolutely. And add that to, we're in a pre-election year. So pre-election years tend to be extremely strong, whereas midterm years tend to be extremely weak. So, you start adding all of this stuff together. I think it's favoring the Bulls in 2023. So, switching gears a little bit, next thing I had was a blog post from Mike Piper on January 2nd titled "My Experience with Check Fraud and What You Can Learn from It." So I talked about this a little bit on an episode of Questions with Mark and Matt. But Mike wrote a personal check in early September of 2022 for $5, Nick, that he just dropped in a USPS mailbox. And he was like, it's $5. It's not a huge deal. So Jenna's going to throw up on the screen, a scan of that check that was written by Mike. And next to it, you're going to see a check that was deposited that was the same exact check. However, the dollar amounts and the payee were a little different. So if you're looking at our YouTube video right now, you'll see both checks, and then Jenna will throw these in our show notes as well. But someone intercepted the check and chemically washed it to remove ink on specific portions of the check and wrote in a new payee and amount. So the first check that he actually wrote was for $5. Someone chemically washed it to be $2,151, and it was paid to a person rather than an organization that he first made the check out to. So this is, pretty scary that people are starting to do this now, Nick. And per the police detective who was in charge of the case, they're getting approximately 30 of these reports per day, and that's just in one patrol district, so just a few neighborhoods in St. Louis. Mike said that eventually they got their money back, but in total, resolving the situation took more than 3 months and required 14 phone calls, including, he doesn't know how much time spent on hold, 2 visits to local Bank of America branches, and 2 visits to the police station. And he said that if he hadn't scanned the original check before mailing it, the process likely would have taken a lot longer. But they had to close their checking account. They had to open a new one, switch everything over that automatically was charged with their old checking account. And, essentially, even if you get your money back, it's an experience you definitely don't want to go through. As far as being able to avoid being on the receiving end of check fraud, I think that, and Mike points this out, the easiest thing to do is just avoid mailing checks all in general. Just pay electronically whenever you can. It's very common that you can set up bill pay and you can just electronically make payments and link your bank account. So if you don't have to mail a check, then don't do it. But if you do find yourself in a situation where you absolutely have to mail a check, possibly have it sent via your bank or using a bill pay feature rather than writing it by hand. And if that's not possible, he recommends writing the check in Sharpie because that ink is the hardest to remove and chemically wash. But this was how people paid a lot of stuff back in the day, Nick. And no one ever thought that you could chemically wash a check to get the ink out of it and change the payee and change the dollar amount. But this is happening 30 times a day just in a small little district in St. Louis. So I have to imagine this is happening all over the country right now. So it's just important for people to be vigilant and try to do things electronically if you can.
Yeah, it's a pretty wild story. I peeked ahead and read a little bit about this. And
I know it was interesting. My eyes were like, when I was reading it initially on Mike's blog, my eyeballs were like popping out of my skull. Interesting. Last thing I have, Nick, is a blog post from Ben Carlson titled "What Happens If Housing Prices Fall by 20%." And he says from April 2020 through June 2022, it's another wild stat, housing prices in the U.S. rose more than 41%, which is basically a decade's worth of price gains in a little over 2 years. You simply can't have that happen for the most important financial asset for the majority of U.S. households. there's a possibility that home prices simply stagnate for a while to work off these gains. However, the rapid rise in mortgage rates also increases the probability of a more substantial fall in prices. Ben says even if we do get a 20% sell-off in housing prices, it's not likely going to have the same impact as the housing crash in 2008. The credit profile of borrowers is far better now than it was back then. Jenna will throw this chart up, and it shows the mortgage originations by credit score. And as you can see, over the past several quarters, credit scores were, pretty high for people generating new mortgages. And I think this is the key thing here, Nick. He said that the majority of homeowners have locked in rates at 4% or less. So even if prices fall, most people are still going to be able to pay their mortgages. And again, another key difference from back in 07, 08, mortgage rates were higher. And even prior to that, in the late 90s, I've talked to people that had mortgage rates, in the double digits, 11, 12, 13, 14%. So I think this is a big key here, is that, so many people have locked in low mortgage rates after refinancing during COVID, that I don't think it's going to have as big of a ripple effect, in terms of foreclosures. And another interesting point that Ben points out is that he said that there is an enormous margin of safety built in with all the home equity that's been accrued from the housing bull market. And he throws this stat out there, which is wild. And I mean, if it's accurate, then that's crazy. I don't know how accurate this is. It looks like it's coming from AHS, First American calculations back in 2021. The key stat here is that 42% of owned homes are free and clear. And that is way higher than I would have expected, Nick.
Yeah, it was a little high than that jumped out to me as well. I wouldn't have guessed that high. But thinking demographically, I guess it makes sense when you think about how large the baby boomer generation is and kind of, where they are on average in their age. You would think been in homes much longer. And, I just think about my parents as an example, and, that kind of age, mid 60s, kind of getting towards retirement. A lot of people have already paid off their homes, and obviously that's a big bulk of the population. And I was thinking about a lot of demographic research that we've been reading in the markets about how the workforce is changing, and a lot of the baby boomers are retiring. And so it makes sense that it's high, but yeah, that still seems pretty high for even thinking about all the demographics with baby boomers. So
yeah, and that's a good point too, because obviously people that are owning homes are on average older, and the younger generations are actually already showing that they're not owning homes as early as the baby boomers, or right, anyone else that is kind of in that older generation, or generations. So it makes sense, and the older population tends to stay in their homes for longer, et cetera, et cetera. So it makes sense that there's a decent chunk of people that own their homes free and clear, but 42% is a lot. So all in all, we've been kind of hammering this point home since COVID, is that, eventually we're going to have a pullback in housing prices. Is it going to do as much damage as it did in 08? We've been in the camp that it's not going to be, just because there's different things going on in the mortgage and housing environment than there was back in 07 and 08. So we continue to be in that camp.
Yeah. I 100% agree. One point I'll make for listeners, just to give a little perspective on that 41% gain that you talked about previously. And what was it? Here it is. Housing prices in the U.S. rose more than 41% from April 2020 through June 2022. I'm not going to quote the exact average because I don't remember off the top of my head, but a normal kind of range that you could expect housing to appreciate on a yearly basis is more in the 2 to 4%, not 20%.
Yeah.
So
it's like a stock portfolio.
Yeah. I mean, it's the 2 to 4% is normal. If we were saying, during that time period, it was up 8%, we would say, that's a great 2 years. 41% is astronomical. So just to give listeners a little bit more to go off there on what is normal. So
Right, it is. And now that we're kind of talking about this is what I love. I love doing podcasts on video conference because I can look stuff up really, really quickly here.
yeah,
But I want to just quote the average mortgage rate right now, because I think that's really interesting.
it's got to be mid single digits, right? Or
Yeah,
lower.
let's see.
Well, yeah.
30-year. Courtesy of Y charts. Thank you, Y charts. As of the week of the 12th, 6.33% is the average mortgage.
Which is
30-year mortgage rate.
Yeah, which is also really good in the context of history, I think.
Yeah, it is. Yeah, if you blow out this chart on the max, in 1980, mortgage rates peaked at almost 19%.
Yeah, the 80s were wild for rates. Yeah.
And I mean, we got as high as 7%, back in like November of 2022. So I think, people are in this weird time where if they're growing their families and they need more house, they're thinking long and hard about if they want to move because of how much more they're going to pay in a mortgage. They're locked in at, sub 4 or 3%. And they're like, hey, kids, you're going to bunk up for a couple of years and you're going to share rooms because, you can't beat this rate that they have. So it's an interesting decision that families are going to have to make. But yeah, at least the average mortgage rate has come in a little bit from the high, and if prices and inflation come down and yields start to come in a little bit, I would expect that to continue to fall, but we'll see what happens.
We shall see. It'll be another interesting year in the markets, as always.
All right, that's
never
it for me.
Shortage. There's never a shortage of things to talk about in the markets.
No, there's not. We could do a podcast today.
That's what makes the job fun. So
yeah.
The first piece of research I have here is actually very quick. It's just a quote that I thought was interesting from a Bloomberg market recap article. They throw those out every day. They're typically pretty long articles, and they'll pull up charts and they'll grab comments from analysts and sell side research analysts and buy side research analysts, etc. And the quote that I wanted to read here is as follows. We expect 2023 to slowly see a shift of the market worrying about inflation to worrying about the economy, which is more of a hard landing narrative. And this is coming from Jonathan Krinsky, and he's a chief market technician for BTIG, which is a big research house. And again, it's a quick piece of research. I just throw this out to listeners as a fair warning of what to expect over the next year, because we're already starting to see this, and it's going to be very similar to what we dealt with last year with inflation, where you read about it every day, it's in the headlines, and everyone's talking about it, and all of this and all of that. That narrative is going to slowly change, as it always does in the markets, and we can only stay on one topic for so long because things are changing. And the big narrative, I think, will be about the recession, and is the recession coming? Worrying about the health of the economy, the underlying strength of corporate earnings, and the hard landing narrative. I think you're going to start seeing that in the headlines with much more frequency over the next year. So,
yeah, I think just like anything else that happens in the markets or the economy, people are going to have pretty short memories, and inflation is going to be eventually a thing of the past, and there's always going to be something else that grabs the news headlines. And yeah, like we talked about last year, we're going to see some more crappy economic data, and that's going to start to grab the headlines. Where it starts hitting, Main Street America more is obviously when you start to see increased layoffs and
the jobs,
job loss and that type of thing. So yeah, I kind of agree with that.
Yep. So just a little bit of a forecast there for listeners. Just expect it in the headline. You're going to see it this year. That would not shock me. So the next two pieces of research I have are more chart and technical focused. This is a tweet from yesterday, actually, and this is a chart from that was created from Bank of America, their research house over there. And the quote here is 65% of the S&P 500 stocks are above their 200-day moving average. And it's a great chart. Jen will throw it up here, and it's kind of a 2-for-1 special here, right? Because the chart on top, it shows the S&P 500, just the index pricing, and it also shows your, let's see, what is that? Yeah, there's the 200 simple moving average. So you can see where we are, and there's been a lot of talk on this, and at least the financial news that I follow, about bouncing off the S&P 500, bouncing off this 200-day moving average. There's a lot of technical resistance there, and you can make an argument on both sides. But when you kind of peel the layer back, you look at this little chart underneath it, and that shows the percentage of S&P 500 members that are above their 200-day moving average. And so that's where you kind of see there's a lot of bullish technical indicators when you kind of peel that layer back and see what's going on the underlying side of things, not just simply looking at the S&P 500. And again, that quote of 65% of the 500 stocks are above their 200-day moving average. That's really good. That's a nice show of strength, despite the S&P hovering, bouncing off this 200-day moving average. So pundits on both sides of this argument, as far as where we are with the technical resistance on the 200-day moving average. But when I look at this chart, I see a little bit more through the bullish lens, especially in context of some of the other things we mentioned, with the positive technicals from the January comments you made on the Santa Claus rally, factor in what a weak year it was in 2022. I view this more through a bullish lens, but what are your thoughts?
Yeah, I agree with you. A couple things stand out to me. Number one is, so, right now, approximately, 65-66% of stocks in the S&P 500 are trading above their 200-day moving average. And, again, going back to the fundamentals of it, the 200-day moving average is really just a simplified signal as to if a stock is in an uptrend or a downtrend. So, stocks that are above their 200-day moving averages, we clarify that as being in an uptrend. Stocks below their 200-day moving average in a downtrend, and it can oscillate up and down and kind of chop around and go nowhere, right, Nick? But, if you look at this chart, we haven't had this amount of companies above their 200-day moving average since December of 2021. So really a little more than a year ago. So, and each time the S&P 500 has tested this downtrend line throughout 2022, the percentage of stocks above their 200-day moving average was slowly grinding lower. But, this test of the trend line, the percentage of stocks above their 200-day moving average is higher. And another key thing to note, at least for me, from a technical standpoint, we made a new low in September of 2022. We went up, tested the downtrend line in, November-ish, fell back down in December, but we made what we call a higher low. So in December, the markets didn't go on to make new lows at all. Before coming back up again and testing this downtrend line in the 200-day moving average. So that's the first higher low we've made since this bear market started. So again, that is a positive thing that we have not seen yet. And I would continue to expect that if the percentage of stocks above their 200-day moving average continues to increase, that eventually we're going to get a break of this downtrend in the main markets. And the S&P 500, for listeners, is what we call a market cap weighted index. And all that means is you take the stock's price times and multiply it times its outstanding shares, and you get the market cap. And the higher the market cap, the more weight that is given to the company in the S&P 500. So, the big dogs of the S&P, Apple, Amazon, Microsoft, Tesla, Google, Johnson and Johnson, those type of names have more weight and can throw the index around more than, you know, a company who's, you know, 490th out of 500 in the index. But we'd like to see more stocks participating in an upside move than just a handful of large tech names. And this seems like it could be the beginning of that. And you know, if we do get a lot of these tech names start to turn around after they've been, you know, beaten down for the past 2 years, man, watch out above, because if you have smaller companies in the S&P 500 above their 200 days and these big, larger tech names start to join the party, be a significant move to the upside.
Yeah, start to see some positive momentum on the big picture side of things on the indice level. A lot of underlying strength. Yeah, that's an interesting one. I hope listeners enjoy that chart. The last piece of research I have is another good chart, and you mentioned it a little bit at the beginning of the podcast with the pricing. This is a tweet from Mike Zaccardi. He's a CFA and CMT. He's a financial reporter. He writes for SoFi, a bunch of Reuters, a bunch of different other news sources. And this is another very simple chart, but he just has one line that says, "Are y'all chasing foreign stocks here?" Y'all is a quote. That's not my southern twang.
Southern twang.
That is a direct quote. And it's a good chart for multiple reasons. And Jen will throw this up for everyone. It's the relative performance of VEU to VTI. So VEU is the Vanguard FTSE All World X US ETF, and that's actually what we talked about in the podcast at the beginning with pricing. And then VTI is just the Vanguard Total Stock Market ETF. So it shows relative performance of international versus what is domestic for us as U.S. citizens. So international versus U.S. and relative performance. And one of the reasons I really like it is because he, you know how I feel about historical context and looking at the history of things. It does show the historical context of just how strong our domestic markets have been over the past decade. And it's also interesting to see this bounce here at the very end. Obviously, you mentioned it at the beginning of international doing a little bit better and showing some signs of life after 15 years, 20 years.
I think the biggest thing
that
stands out to me with this chart is that, you know, there's academic theory out there that, you know, you always need to have a portion of your portfolio allocated to international stocks. And I think this chart just completely blows that out of epic proportions. I mean, from 2007 to 2023, if you were overweight or had a significant position in international stocks, there was just a huge opportunity cost there with not being invested in the US. And hey, I'm open and ready for this to potentially change. And, you know, we would be open to adding more international exposure and portfolios if this trend changes. But, you know, just from what we've seen over the past couple of months of international outperformance, I mean, it still is microscopic compared to the past decade on, you know, how badly U.S. stocks have outperformed international stocks. And maybe this is the time that the tide turns. I don't know, but I'm definitely going to need to see a little bit more than what we've seen the past couple of months to see that this thing has really started to turn around.
Yeah, exactly. This is still just a moderate blip in what we could call temporary outperformance. Certainly is in the chart. You can see that clearly in the chart, right? I mean, it's a clear downtrend, but it is an interesting little blip up there. You know, the context of the market starting out a little stronger and having some technical tailwinds and coming off a bad year. You know, a lot of, I mean, you could argue value out there. That's interesting to see.
Yeah, it is. And I would argue that at least for right now, it's a cyclical kind of uptrend within a secular downtrend for international stocks. And this has only, again, happened for the past couple of months. So we're going to need to see more strength before we can say, hey, this is a turnaround that, international is going to begin to outperform US over the next however many years. But as always, we'll just wait to get the information. But right now it's still like, hey, we should be a little cautious about still adding a bunch of international equity exposure right now.
Yeah, certainly. Well, that's everything I had for listeners.
Yeah, well, thanks for filling in today, Nick. I appreciate it. I'm sure listeners did as well.
Yes.
So we're gonna bring,
always good to be here.
Yeah. Well, we're gonna bring Taylor on for the financial planning topic of the week. So again, Taylor is our wealth advisor and paraplanner here in the office at Jessup Wealth Management. And I believe today that Taylor is going to be talking about Social Security. So I know that this is one of the hot button items, that questions we get from clients, especially when we start working with new clients, is surrounding Social Security and when should I take Social Security? Should I take it while I'm still working? Should I take it early, my full retirement age, or delay it until age 70? So Taylor, welcome back to the show, and you can go ahead and jump right in if you'd like.
Yeah, so first, I just want to talk about Social Security while you are still working, because we do get a lot of questions about that too. So as a reminder, you do receive your full Social Security benefit at your full retirement age. So that's going to be between age 66 and 67, just depending on when you were born. So if you take benefits before your full retirement age and you're still working, you will receive some kind of reduction in your benefits. But if you're taking benefits after your full retirement age and you're still working, your benefits are not going to be reduced, which is really nice. So if you are under the age 66 or 67 and you are working, there will be some kind of reduction. So if you earn anything below $21,240 in 2023, $1 is going to be deducted from your benefit payment for every $2 above that income level. Now, again, if you reach full retirement age this year, only $1 in benefits is deducted for every $3 you earn above $56,520. And your earnings are only counted up to the month before you do reach that full retirement age, so not for the entire year.
Yeah, so I think, sorry to interrupt you, Taylor. So I think, a lot of people are probably like, wow, there's a lot of like calculations, and, I lose $1 in benefits for every $3 above a certain amount that I earn. So, I mean, I think that the key takeaway here for people is that, if you can wait, you should wait most of the time to take your Social Security benefits until after you're done working. And especially if you can wait till age 70, because that's going to be the max amount of benefit.
Exactly. Yeah. I mean, age 70 is ideal. I know that's not realistic for everybody, but at least wait until age 66, 67 if you can.
Right.
So just kind of continuing on with that, like I mentioned, Social Security won't withhold any money from your monthly benefit if you are at that full retirement age, and they also won't take any money out of your checks either, as long as you're below that income threshold for the year. Now, regarding tax, if you are still working, whether you have earnings from working or it's other taxable income, like distributions from a retirement account, so an IRA or a 401k, part of your Social Security may still be taxed. So it doesn't matter if you are employed or retired. You could pay taxes on up to 85% of your Social Security benefit If you are single with income of $34,000 or higher, or if you file married filing joint and combine your taxable income is higher than $44,000. Now that number does drop a little bit, so you will pay taxes on up to 50% of your Social Security benefit if you're single with taxable income between $25,000 and $34,000. And if you're married filing joint, it's 50% if your income is between $32,000 and $44,000.
Yeah,
So,
and I think it's probably eye-opening for people that, the thresholds really aren't that high, right?
No, not much of a decrease.
No,
from
not at
85.
all. No, not at all. So, and the other thing I want people to understand too is that, we're talking about taxable income right here for these thresholds, Taylor. It's not gross income. So taxable
Correct.
income is obviously after all the deductions and everything and credits and things like that. So, if you're someone that makes, $50,000 per year, more likely than not, your taxable income is going to be less than that. So that helps, but still these thresholds are not very high.
No, and a lot of times people think that Social Security doesn't get taxed at all, and I can see why people think that. But unfortunately, that's just not how it works.
Yeah, that's not how it works. There's certain states where Social Security isn't taxed at the state level, but at the federal level, usually it is.
Yeah, exactly. So yeah, just kind of all that information together. Key takeaways are, like we just said, wait until your full retirement age. If you can, to take Social Security, obviously age 70 would be ideal, but that's the simplest way to maximize your benefits if possible.
Yeah, well, I appreciate you going through this, Taylor, because I think this is, the basics of Social Security, I think, are easy to understand, but there are so many different scenarios that could happen surrounding Social Security that a lot of times people have questions on. So, if anyone has questions about their situation, feel free to reach out and Taylor or someone on our team will get your questions answered. But appreciate you bringing this up here, Taylor.
Yeah, of course.
All right, everybody, that's going to do it for us. We're going to be signing off for the week. Thanks for tuning in to episode number 185. I hope everyone's had a great start to 2023, and we'll be back with you next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.